Okay, great. Good day, everybody. Let's get started. My name is Emmett Kilduff. I'm one of the co-founders of M&A firm, the Fortia Group. Welcome to this webinar. We're delighted to have a super lineup of speakers to present on what it means to become exit ready, how important it is, particularly to ultimately get to the best terms when you want to exit. So let's jump in. The agenda for today, we'll do introductions of the four speakers in a moment. We'll talk about, the market dynamics, a lot of data-driven analysis that we'll present through Catherine at OpEx Engine. We'll talk about, I'm sorry, I'll do the market dynamics. Catherine will do company performance and data. We'll talk about what it means to become exit ready. We'll get into the legal deal dynamics of actually getting a deal done, and we'll finish with one of the topics on everyone's mind is where are valuations at and how to get the highest valuation. In terms of housekeeping, please do submit any questions you have via the Q&A button on Zoom and not via the chat button. It's much easier for us to share and to chair, excuse me. And we will send this PDF and the recording of today's webinar to you all as part of the follow-up and to anyone else in the SaaS space that can't attend. So let's jump in. So from an introductory perspective, as I mentioned, I'm the co-founder of the Fortia Group. I started my M&A career back in 2000, 25 years ago. But just before that, I did a master's in e-commerce, and the e-commerce was the rage at the time. So I joined the investment banks to look to do initially e-commerce and then sort of broader tech deals. I've done over $20 billion worth of deals over the last 25 years, small, medium, and very, very large. And so love helping entrepreneurs ultimately get their the best deal done and across the line. I'm not just a geeky investment banker either. I've started four companies myself, so I'm entrepreneurial, and hopefully that helps when it helps build a chemistry with entrepreneurs like yourselves. So could I ask our panelists to each turn on their cameras and give an introduction of themselves? Catherine, over to you.
Thanks, Emmett. I'm Catherine Zhang. I lead OpEx Engine by Bain & Company. We support SaaS companies make decisions with our benchmarking data. And I've spent the last decade scaling strategy and revenue operations across tech companies. I think I actually see possibly some people I worked with in those roles in the attendees. So hi again, if I've worked with you in the past. I'm looking forward today to using some of that data and sharing some practical insights on what we've learned for companies thinking about making an exit. I'll turn it over to Caroline.
Hi, everyone. I'm Caroline. I am a corporate partner at UK-based law firm MBM Commercial. We are boutique in size and entrepreneurial in spirit, and a bit similar to Emmett. I did a few years in the big law firm days doing the big deals, and now I'm very passionate about supporting entrepreneurs on their exits. And we'll get into some of the meaty stuff in a bit more detail, but advising entrepreneurs on their sales to buyers is our expertise. Robin, over to you.
Thank you, Caroline. Similar to Caroline, hi, my name is Robin Sears, and I'm the founder of Speed M&A within Jones Frost. I was actually an entrepreneur for 10 years before going to law school, launched a .com, sold a .com in the early 2000s. So I really sat in the seller's seat, and I know the challenges and the excitement of becoming exit ready. So we also guide sellers and buyers in M&A. We're a full service boutique law firm. And looking forward to the conversation. I think it will be fun. Caroline and I will be able to share cross-border perspectives between the differences of doing deals, because a lot of folks on the call might be doing deals in more than one jurisdiction. So looking forward to that.
Thanks, Robin. So the way we're framing today's webinar is based on how we think about the items that drive a successful exit. The scary stat is that 80% of companies that go to market don't actually get a deal across the line. So many people put in 6, 9 months of work and don't get a deal across the line. That's a lot of energy and time wasted, and what that amount of work takes your eye off the ball of the core underlying business. It's not something that we want you all to be doing. So, how can we help you succeed? First of all, there's a big macro world out there. It's really important to keep one eye on what's happening in terms of the market. The macro affects the micro, what can be done on a deal basis. It's really important to be on top of company performance and to understand what acquirers want. Deals have to be win-win, right? It's a two-way street. It's important to understand how deals get done, what the processes are, what are the pain points, how far can you push buyers on various things, and so on. All of those points, are really key to getting a deal done. My biggest takeaway for you all from today is if you fail to prepare, prepare to fail. Our best exits are where, and this is over 25 years, the best deals we've done are those where we're starting to work with the entrepreneur 1 to 3 years out from doing a deal, not 3 to 6 or 9 months out from doing a deal. That's not being thoughtful. It's like a marriage. Think of it as flirt, date, marry. If you want to ultimately have a really strong marriage, you need to have a period for dating, a period for flirting with the buyers, and then cement the relationship. So M&A is no different. Think of it as a 1 to 3 year prep. So let's jump into each of these components. From a market dynamics perspective, there are three sort of macro factors at play. There's the global M&A activity. SaaS M&A activity is impacted what's happening on a global basis across all sectors and regions. There's obviously thinking about public comparables. How are listed SaaS companies doing? That's got a direct, correlation to how private unlisted companies are doing. And we need to keep an eye on SaaS investing trends and activity. And there's lots of movement there at the moment. And, it's hard to keep up in some ways. And we'll talk about, the impact of AI and various other forces. So let's take a step back and put sort of M&A into context. So we've gone back just over 10 years here to paint sort of the picture. I think, as you all know, like 2021 was a bonanza for deals across most sectors and most geographies. Things changed since then. Interest rates have gone up. There's been a lot of uncertainty in terms of interest rates, but also more recently tariffs. This year, for the first 6 months of the year, we're at 1.9 trillion of total deals globally. So we're on a better run rate than last year, and hopefully we can finish up on last year. But it's not a massive jump. It's not likely to be a massive jump. Certainly not back to the good days of 2021. But at least sort of symbolically, we're going to have a small increase. If we break that down then into what corporates are doing, and in a moment I'll show you what private equity firms are doing. A lot of corporates are sort of in wait and see mode, unfortunately. This time last year, we were more optimistic. Interest rates had started to come down in September 24. A lot of people were saying, post-election there'll be a big flurry and return of M&A. And I'm just talking about global M&A for the moment, not necessarily SaaS specific. And then there was a spanner in the works really in Q1 of this year when the tariff announcement came about. That really sort of spooked a lot of corporates, and I think a lot of boards sort of went from a risk on to a risk off perspective. And you can see from this data that it looks like we're going to be flat year on year from a corporate M&A perspective, which is sort of disappointing. However, to put a positive picture to this, like corporates grow through organic growth and inorganic growth, and at some point the boards will have to come back to the market more aggressively and do deals and not just rely on organic growth. So hopefully that means 2026 we'll see a stronger rebound depending on macro situations like wars and interest rates and maybe further surprises on things like tariffs. If you look at the private equity side of things, again, it looks like flat year on year. This sort of frankly annoys me because private equity firms are sitting on a lot of cash, and the people that give them that cash expect them to put the money to work. and the private equity firms are charging very handsome fees to manage that money. And at some point, either the people that give them the money will ask for some money back, or they'll have to put it to work. Again, there's some dynamics that are similar to corporates in that they're waiting for interest rates to come down. But I would expect that we'll see a big rebound in 2026 from private equity, again across global sectors. So what's happening in the listed markets is really important for us all in the private unlisted markets. SaaS Capital Index is an index we've been tracking for several years. The founder has put together this index of about 120 listed SaaS companies into one composite index. And to me, it's the best metric for tracking what's happening in the public markets for SaaS. You can see back in 2021, the numbers were crazy, right? Up to sort of 17 times revenue. That was obviously a super time to exit if you managed to get a deal away back then. There was a big drop since then. And it's been sort of, stable-ish over the last while. It hasn't really fallen much below 6, but hasn't gotten, much above 7.5. So the trading range has been sort of, let's call it 6 to 7.5. And what does that mean for you all on the call? It means like, valuations, that's a pretty sort of tried and tested range over the last 2 to 3 years. Remember that they're liquid SaaS stocks. They mightn't all be as high growth as your firms, but they're liquid, and typically private unlisted companies trade at a discount to listed companies. So it has an impact for how we can get deals away in private SaaS firms. The interest rate environment, obviously, we all want interest rates to come down across the world. The Fed, the BOE, the banks here in Europe, that will have a positive impact on valuation. There's definitely a move towards bottom line over top line. If you go back to 2020, 2021, what acquirers were looking for was sort of nearly growth at all costs. And it's easy to forget. It's easy to forget that in the tough times, or when the going's good, a lot of acquirers forget about the bottom line. Honestly, they just chase top line because their own investment committee are asking them to chase growth. Right now, obviously, profitability is more important, given the more difficult trading environments, and of course, more of a focus on revenue will return. And that's one of the difficult things for M&A. You've got to sort of forecast when you're going to sell and sort of skate to where the puck's going to be. So if you want to sell in 3 years, will the market be looking for profitability or revenue or a mixture? That's a difficult question to answer. I don't think anyone has a proper crystal ball. So it's important to sort of develop a relationship with an M&A firm and keep thinking about that so that you're gearing up in the right way. AI disruption fears obviously have taken a massive impact on SaaS and other sectors. So there's some interesting data from our friends at OPEX Engine here that shows the annual recurring revenue growth for unlisted SaaS companies has had a tough time since 2021, since that peak for both performance and M&A, coming down from the peak of 35% year on year to 11% year on year. So look, it's getting harder on average for SaaS companies to achieve growth. That means multiples are compressing, but it also means that if you are an outlier, if you're showing above average growth, then you're going to be in demand. You should have a more competitive auction and therefore have a good chance of getting a very handsome multiple. So let's look ahead. I've touched on a few of these points, but we at the Fortea Group see interest rates softening, which will be a catalyst for more M&A volumes. There's an inverse correlation between interest rates and M&A. We've seen that over the last 25 years. As mentioned, all that money on the sidelines can't stay on the sidelines forever. PE will have to start deploying it. The risks are more trade policy, tariff type announcements, further geopolitical uncertainty. There's definitely probably more diligence being done and more caveats and maybe holdbacks being done from payment perspective, definitely seeing more deferred components of consideration than we did in 2020, 2021. So what does this mean? It means there's a premium in quality assets. Diligence is getting more intense. There's definitely different priorities depending on the buyer, whether it's a strategic, a family office, a private equity firm, a search fund. They all have sort of different nuances, and really to sort of be best prepared and get the best terms. Please think about starting your preparation early. Become exit ready, and we'll get into that in a bit more detail in a moment. So that's sort of step one, the market dynamics. Now, Catherine will take you through company performance.
Great. Thanks, Emmett. So unlike market dynamics, where Emmett mentioned there is a lot of, let's say, not so positive things going on, the nice thing about company performance is that it is something that is very much in your control, unlike the market dynamics. But even though it's in your control, it's not always easy to know exactly what to focus on and like how hard you have to push your performance to get a successful exit. So what we're going to go through in this section is I'll go through just a couple of the most important business performance measures that investors focus on. And I'll show you what we've learned from OpEx Engine's performance database on where the bar is set for a successful exit. So we start at the top here with Rule of 40. We started here. You've probably all heard of Rule of 40, I'm sure. So as a reminder, the Rule of 40, what you do is you take your growth rate, usually it's ARR growth rate, and you add it to profitability, usually it's EBITDA margins profitability, and you see what that number is. So you've probably heard this metric a lot, but why is it talked about so much? There's two main reasons that we've seen from talking with both SaaS companies and their investors. So one, it really is a balance here. So you can get to Rule of 40 with either growth or profitability or a mix of the two. And it's very much the trade-off between high growth and high profitability. Ideally, we all would love to have a company, all investors would love to have a company that is both high growth and high profitability. But I think most investors know that that is very rare that a company has that. The other thing that's great about Rule of 40, though, and it's very relevant for what we're about to discuss, is Rule of 40 rolls up a lot of other performance metrics in this neat little bundle. And the way that it does that, though, means that one thing when you look at Rule of 40 is you can't just look at the components of Rule of 40. The growth and profitability numbers are outcomes of your operating performance. They don't actually tell you what you need to fix to get those higher. So what we talk about when we talk about business performance is we want to go one click lower, and some of these metrics you'll see feeding into growth profitability here, or even 2 clicks lower below this. Next slide, please, Emmett. Before we get into the actual data, I just want to give you a sense of where the data comes from so you know what you're looking at. OpEx Engine is the most comprehensive database of operating performance metrics for B2B SaaS companies. We are a subsidiary of Bain & Company, and we've been around for many, many years. We've collected a ton of data here. We have over, you can see on here, 1,200 participating companies. We track super in-depth metrics of over 250 of them. We really seek to drive these insights that can drive decisions for operators and investors through those metrics. And very specifically related to the topic today is when we look at everyone that's been in our database up till now, about 1/3 of the companies have exited within 3 years of benchmarking with OpEx Engine. One other thing I should note on here, and the insights part, is we heavily validate the data. So this is not you get to enter data randomly into a spreadsheet and send it to us. We'll go back and make sure this is the most accurate data so that you get the most accurate comparisons there. So everything you see in the next few slides is from our proprietary database. It is not from public information. All right, next slide, please, Emmett. So talked about the balance, talked about growth and profitability, mentioned Emmett already showed you earlier, growth rates used to be very high. Not surprisingly, everyone was getting and burning a lot of cash at the same time. So EBITDA margins were very low. What this shows is on the top, it has the growth rates for SaaS companies. It's similar to the slide that Emmett showed, but what this is doing is breaking it down for you by size of company. And you can kind of see that the dip is really, really severe for the smaller companies versus the larger ones were never quite like at that height, even in the 21 to 22 era. And the bottom chart shows the movement of EBITDA margin over that same period. And what was interesting when we did this analysis earlier this year is it's the first time that we've seen even the smaller companies go almost positive in margin. I'd call this sort of our benchmark is you can roughly equate it to an average. It's not quite the mathematical average, but it's kind of like your average company in the 50 to 100 million are actually just positive EBITDA, and even the 10 to 50 million companies are edging up there. They're like at -5% or so in the past year. So that's been interesting to see that that shift. So next slide, please. So that's the overall rule of 40. So how does this compare for companies that are actually going towards an exit? What I showed you last is all companies. So what we did is we looked at our data and we found a set of companies where we actually can track their performance over 1 to 2 years directly before they made an exit. And that's what the data is showing in all of these next few slides. So we'll start with the growth side of Rule of 40. And what we found here is that the focus as you're exiting is to maintain your growth. It's not necessarily that you have to beat the market growth or even that you have to accelerate your growth, because what you can see with the bars here is left-hand bar is 2 years before exit, right-hand bar is 1 year before exit. There's like very little change in the ARR growth rate. You're not shooting up in growth suddenly. You're not decreasing in growth massively either. You're kind of maintaining there. And you are just slightly above the red line. The red line is all companies, whether they're going for an exit or not. So the idea here is you don't have to hugely outperform the market. It's nice to be a little bit above in terms of growth, but you do want to make sure you're maintaining that ARR growth and you're not, you are a sustainable company. You're not showing that you are decreasing there. So that's what we found in terms of ARR growth. Next slide. Other side of the Rule of 40, in terms of margin, different story than growth. In terms of the margin, we do see a market improvement needed here. So again, same thing, 2 years before exit, 1 year before exit. Line is all companies, whether they're going for exit or not. And you can see there is this market improvement in margin in the year before they go for exit. This is partially, we think, due to the fact that your margins are really the way that you show that you are a sustainable company. An investor is not buying you for the company you are now, they're buying you for the company that you will be in the future. So being able to show that you are improving your operations and making them more efficient is very important here. And especially if you think about the last slide where you're sustaining your growth, but you're doing it on a lower cost base, that's what investors want to see, right? Is that you are scaling, you are not just, you don't have this completely linear relationship between $1 of cost equals $1 of growth. The little call out here is as we dug into this data, what we've seen is most of the EBITDA improvement is driven by reductions in OpEx. It's not reductions in your cost of revenue and things like that. Usually it's sales and marketing expense. Again, it's an easier expense to get efficient than some of the other expense buckets. It varied a lot between what companies were improving, but generally there were more sales and marketing expense dips than in other areas of expense. Okay, next slide, please. So we're going to peel back one layer from each of the growth and profitability. So growth first, one of the metrics under growth that we're going to look at here is retention. So going back to want to make sure that you're a sustainable company if you're going up for exit, what you can see with retention is that you want your retention to be over 100%. It means that you are keeping and retaining your current customers.
Obviously, that's important if you want to be a sustainable company. It also shows that you're not a leaky bucket in SaaS terms. You are not losing customers and having to refill your customer base with new acquisition all the time. Next slide, please. Going to go one more on the profit side. We looked at operating cash flows before exit. This slide's a little bit different. The blue bars are if the company was corporate acquired, the green bars are if they were PE acquired. We split it that way because there is actually an appreciable difference in terms of how good your cash position needs to be. Not surprisingly, if you are going for a PE acquisition, they tend to want you to be in a better cash position, better profitability position than if you are going for a corporate acquisition. And again, remember the EBITDA markedly improves from year 2 to year 1. The same here, right? This is one of the things that's helping drive that is your net cash position is getting better. So strong cash position is very important, especially if you are looking to get acquired by private equity. All right. That is just a very quick overview of a couple of metrics that we have in our database to give you a sense of, or start to give you a sense of where to focus and which ones you have to push hard on and which ones you want to more maintain. So I will turn it over, I believe, to Emmett to talk about how to get yourself exit ready.
Thank you, Catherine. Brilliant stats and data points there. We don't, as M&A advisors, we don't often get to see sort of the real sort of proof and evidence behind some of those trends. I think that's really helpful for the entrepreneurs to sort of see how firms gear up and sort of it's somewhat a game, isn't it? M&A, preparing for M&A is somewhat a game, getting the house in order and sort of putting yourself in the best light when you go to market. So that leads nicely on to section 4. How can a company become exit ready? Firstly, it's important to sort of talk about the context. A lot of sellers are thinking about coming to market rather than not. So 35% have said that they're more likely to come to market, and 18% have said that they're strongly looking at come to market. So there's a lot of SaaS entrepreneurs thinking about coming to market, and therefore they really need to be exit ready. It's going to be quite competitive if that many companies are coming to market. There's a lot of choice for the buyers, so you need to stand out, and becoming exit ready is key for that. Over the last 25 years, I've seen a lot of entrepreneurs not really take into account what the most important people in the room think, which is the buyers. What do they think, right? The best laid plans only survive contact with the enemy. You and your board may think what you've got is really sellable, but frankly, the most important people is what do the buyers want? And one of the things we do, which we'll come on to, is put sellers in front of buyers as far in advance of a deal as we can to get feedback. I'll go into that in a bit more detail, but here's feedback from 3 serial SaaS acquirers, SaaS Group, Aslan, and Valsoft. So Gillian from SaaS Group is always talking about proactive preparation of things like financials, IP, growth metrics, operational details. Getting the house in order there helps get a deal across the line. Zoe's talking about clear and accurate operational and financial data, presenting some of the metrics that Catherine talked about in the last section. It's really important to know what your KPIs are, know what the KPIs of acquirers want to see are, and be working towards those. And Blake from Valsoft talks about, have you got the right fit with the buyer? Can you convince the buyer that you're the right fit? There's 3 levels of fit in my view. There's strategic, financial, and operational. And it starts with strategic. If you can't get strategic fit and rationale, there's no point even talking about financial and operational. So you got to put yourselves in the shoes of the buyers. Like, what does a buyer need to see in terms of like the strategic fit? How can 1 and 1 equal 3? And don't just think of yourselves as a seller to try and role play with someone else in your firm as if they were a buyer, and work towards what the buyer wants. So what does it mean to become exit ready? Unfortunately, there's a lot in there. I'll give some examples. So first of all, it's really important for the seller to understand all the different types of acquirers, whether that's strategics, private equity, family offices, search funds, or any other types. It's important to engage the right advisors early, whether that's, tax, financial, M&A. It's important to get the financial house in order. There's a lot of things here then in terms of like management, risk mitigation, value drivers. So that look, there's a laundry list there. Going back to my earlier point, the most important point from my perspective is to follow the flirt, date, marry process. And by that I mean start talking to acquirers before you start your exit process. So show them a teaser of the business. You don't have to disclose all your confidential, financial, sensitive metrics, but show them a one pager about the business and ask them, well, what do they think of it? Ask them if they were CEO, how would they run it differently? Ask them what should you do to make the business more viable, not sellable? Um, Ask them sort of your key strategic questions. So that could be like, should you expand into Europe? Should you consider adding a new vertical? What should you do with regarding AI? Whatever those might be. That's my biggest piece of advice for you all is make the company as viable as possible by flirting and dating with acquirers way in advance of actually trying to do a deal. And this just doubles down on that. So look, marriages take time, but to really get your attention, let's look at the last one here, higher valuation. There's stats showing that founders who initiate buyer conversations over 18 months before a sale get 22% higher valuations. So start conversations early, and remember, like the folks that will pay the highest multiple are most likely strategics. A lot of the big strategics are like oil tankers. They move slowly. You need to get on their radars early. You need to convince your primary contact at those firms to be sort of saying good things about your business internally at investment committees and other meetings, and sort of warm them up towards a deal. Prove strategic fit, and then you have the best chance of getting the best terms. Okay, so that's sort of the market, the dynamics of the company performance, how to get ready. Let's talk about doing the actual deal, and I'll hand over to Caroline and Robin to take you through this.
Thanks, Emmett. That was great. And I think it's probably worth adding, and I'm sure, Robin, you're going to agree with me, but that laundry list is really helpful to have a look at every once in a while, but can also be quite daunting. And we'll take you through the process, a sort of overview of the process in a minute, and then the sort of three elements of a deal that are really worth getting your heads around, and that can determine how a deal is structured and the terms connected with that. And then we can do some comparisons of UK to US markets, as you've got the sort of cross-border expertise on the call. But to the laundry list, probably worth adding that no business is perfect. So don't think that if you don't have every duck in the right position in your business that you're not going to be able to sell. Robin, let's quickly share some war stories. I mean, I've definitely sold businesses that have been trading for 20 years and they didn't have statutory books, which you're required to have under English law, that set out who your directors are and who your shareholders are. So that can also be fixed. It's really not ideal. I do not recommend going down that road, but things can be fixed. So just identify your issues and be wary of them, and then figure out how to either solve them or repackage them in the favor of the buyer. What have you seen, Robin?
Yeah, I mean, I think the other thing is to talk to your lawyers early, because there's a lot of things that can actually be fixed before the deal, as opposed to finding them out in the deal. Being prepared, not being surprised by what is or isn't available to fix is really helpful, so that you already have an answer when it comes up for the buyer.
Agreed. Next slide, please, Emmett. So now that you've spent a lot of time getting your business into shipshape and your M&A advisor has produced a beautiful pitch document for you, you've gone out and presented to lots of buyers and they have presented you with some interest, the sort of flirting, as Emmett has called it, that's all part of the preliminary process, and it's very important, as we've just gone through in some detail. Once you have selected a buyer or buyer has selected you, there can be, the process can be done in several ways. If it's a competitive process, then you go to market and you sort of drum up some attention. You want to come forward with their best offer, then it's up to you to choose. And obviously that's a fantastic position to be in. That's often not the case for many, many reasons, including difficult market conditions, and a buyer, just because they're not in a position to buy you doesn't mean that another buyer is not in a position to buy you. So there are always different elements to consider who your potential buyer might be and the reason that they are acquiring you. That buyer, once chosen and decided, will present you with an LOI, a letter of intent, which typically is a couple of pages long and includes some nice text at the beginning about how much the buyer has enjoyed meeting you and talking to you, and that they are interested in engaging in a potential acquisition, whether that is for 100% or sometimes it's a majority stake. Letter of intent can include very, very little detail or some more detail. It varies a little bit. I typically see that an LOI will confirm the interest of the buyer to engage in the transaction, probably give a valuation or a proposed purchase price within there. And then I have seen that some letters of intent go into the purchase price mechanics in terms of cash up front, deferred consideration later, whatever it is. Often you don't even get that detail. They sort of just confirm their interest, and then what the process is, that their interest is subject to carrying out due diligence, negotiating transaction documents, and finally completing.
Caroline, I would like to jump in for a minute because I am curious on the cross-border on the LOI. So
Yeah.
in the US, once you sort of have signed an LOI, it almost always includes what we call exclusivity, which means at that point, you can't actually go continue to shop your company to another buyer. So the conversation we often have as to how much detail goes in the LOI is what really matters to you as a seller, because your leverage as a seller is at its height at the LOI stage before you've committed to a period of time to this particular buyer and only negotiating with this buyer. And so whereas you might not normally see information around how employees are going to be treated in an LOI, if that's something that as a seller is a deal breaker for you, we'll say, let's handle that now. Do you have sort of a different process and perspective from the UK side?
No, we do not. I completely agree with that. I think that, at least from my perspective, there's a slight difference between an LOI and a term sheet. So an LOI, I have seen many, many buyers produce, which has the sort of nice paragraph at the front about how much they've enjoyed talking to the sellers recently. Often that is all you get. And then you're off into the transaction documents. In an ideal world, you would have that nice little piece of paper that says, okay, we're off to the races. A term sheet would then set out what terms actually apply to this deal. And in that scenario, I completely agree with you. Anything that the seller wants to, or the buyer, frankly, either party, whatever terms are important at that stage and they know so upfront should definitely go into the term sheet. And exclusivity is always part of it. That sort of keeps everyone honest and engaged. It means that both parties are committed to work with each other, at least for a period of time. And there are confidentiality provisions, which means you're not going to share secret information and misuse it. Often that's in a term sheet. Sometimes you have an NDA separately on top of that. You can do it either of which way. But the most important thing about a term sheet is, in my view, despite it not being legally binding, if you include certain terms in a term sheet, and then when you get to the transaction documents, you go back on what you've put in the term sheet, you just don't look so good.
Yeah, I would agree. And it's interesting. One of the things for sellers is there's a lot of words that get flown around in M&A that, sometimes makes it less approachable, right? So in the US, we often have an IOI, right? There's a letter of intent, which has what you're talking about, right? The happy stuff about the buyer, maybe just the economics, and then the LOI, which sounds more like a term sheet in the UK. So, you know,
That is good
also
to know,
being
different languages.
available, right, to know the differences in how, you know, parts of the process are referred to.
Agreed. That's definitely good to know. And we'll get into some of the terms and the meaning in the next slide. So getting back to the overview, you've signed your LOI or your term sheet. The buyer is now going to engage in a deeper due diligence process that usually requires the seller to set up a data room and start uploading documents into that data room that are in response to often a relatively lengthy questionnaire that the buyer will have provided, in which they ask questions around the business. And that will be anything from, please let us have your cap table, who are your shareholders, what are your constitutional documents, through to what sort of commercial contracts you have, customers, suppliers, your employees, your IP and how it's protected. Do you have any bank debt? Have you ever been insolvent? It goes on and on and on. And depending on what the business does, so in the SaaS world, that is the focus is often on employment and IP, because that's where the value is, the IP that you've developed in the tech that you've developed. In slightly more traditional businesses, you might get all the way down to sort of environmental considerations if you have a big old factory that produces dirty products. Not in this scenario. So DD is often ongoing. I think a number of years ago, it used to be that a buyer would want to complete their DD before documents are drafted. That I have hardly ever seen it done that way in the last 10 years. I think nowadays the transaction documents, probably because they've become lengthier as time has gone on, transaction documents are prepared alongside due diligence. Transaction documents can include a number of different things, but will typically include a share purchase agreement or an asset purchase agreement if you're just selling your assets. Share purchase agreement, a disclosure letter, at least from a UK perspective, and we can get into the differences on that in just a minute. A disclosure letter in which the sellers make disclosures against the warranties that are found in the share purchase agreement. Then there are various ancillary documents from board minutes to shareholder approvals to get the deal across the line. If not 100% of the shares are being sold, but a majority, then often there's also a shareholders agreement that's entered into that regulates how the buyer-seller relationship is going to proceed going forward. There may also be, as part of the consideration, certain rollover elements. So if part of the consideration is, for example, the buyer issuing shares in one of its buyer group companies to the sellers as part of that consideration, then there will be documentation connected to that as well. Those get drafted, redrafted, negotiated in several rounds. Ultimately, the parties hopefully will agree on the transaction, sign on the dotted line. You have closing, funds flow, and then there are usually typical post-closing kind of filing requirements that have to get done. So next slide, please. Robin, I'll hand to you and you can get into a little bit more of the detail into what sellers should consider.
Absolutely. Thank you, Caroline. So we often talk about, you know, what are the drivers of how you structure a transaction? And, you know, the most obvious, what everyone goes to is how much am I going to get paid, right? What is going into my pocket? And the top line economics consideration can take a number of forms, right? It can take the form of cash. It could take the form of equity. It could take the form of an earnout where you might have cash at the closing, but then under certain milestones, you're going to receive cash later. Some of the money could be held back at closing, and we'll talk about sort of the UK-US differences on that, where we talk about a holdback or an escrow. So everybody wants to know, you know, what money is going into my pocket. The other piece of this is where are my liabilities? What am I responsible after closing that could chip away what went into my pocket? So for example, if there's a tax issue after closing, if there's a contract issue after closing that happened on the watch of the seller, at least in the US, the seller is actually going to have to reimburse the buyer for any losses from those items after closing. So we look at both what's going in your pocket, but then Caroline and I spend a lot about, you know, our time saying, how do we protect you from anybody taking it after the closing? And depending upon how you structure the deal, whether it's an equity sale or an asset sale, that can change your liability position. And the piece that I think is most overlooked that really can make a material difference is taxes. At the end of the day, depending upon your structure, particularly in the US, it could make a difference from $1 million being in your pocket or not, depending upon how the deal is structured. And I think, Emmett, we're going to talk a little bit later potentially about a concept in the US called qualified small business stock treatment. But in the US in particular, if you are structuring the deal as an asset sale, and when we talk about an equity sale versus an asset sale, the way I think about it is you've got a house and you have furniture in it. In the equity sale, you're selling the whole thing. So if the foundation is cracked, the buyer is taking in, they're assuming that cracked foundation. In the asset sale, the buyer is coming into the house and just taking the furniture. And if they see that there's, you know, a picture that they don't want because it's grandma's picture from 40 years ago, they get to leave it in the house, right? They get to pick and choose what they take, and you keep the structure and that cracked foundation. So your liabilities are sitting in different positions on those deals, but your taxes are also. And so the way that those deals are taxed in the US can have a material difference on what dollars end up in your pocket. So when you go to structure a deal and you're talking to your advisors, you want to say, okay, are the dollars going into my pocket? Do I understand how that works? And do I have the protections in place that I need to maximize those dollars? Am I being protected in a way that after the closing, those dollars stay in my pocket and the buyer can't reach in and take them? And from an overall perspective, I want you to work with your accountants and your tax advisors to make sure that the deal structure results in the optimized tax position for you so that there are no surprises. I did a deal a couple weeks ago, and interestingly, in the US, you can actually do an equity deal and have it taxed as an asset sale. So they buy the whole house, but the tax position is an asset sale. Buyers like that because they get what's called a step up in basis, and they get certain amortization over time. The problem was in the particular state we were in, this seller had set up a trust, and the trust had triggered a 1.5% tax in that state. And 1.5% of a very decent set of economics was truly material to this seller. And at the last minute, we were having to scramble as to what were we going to do, because it changed the economics so dramatically. It was a deal the seller wasn't actually willing to do anymore. So taxes is something that you really want to get ahead of, and where it's truly material, even address in your LOI. Carolyn, do you want to add anything on the UK side before we move on?
I agree with everything you said. From taxes perspective, it's a bit different in the UK, but I think that the principle is definitely the same. And I like your house analogy, the sort of share sale, whole house purchase versus asset sale, buying the furniture, leaving the cracks. The same principles apply in the UK. So I think let's get into a bit more cross-border comparisons on the next slide, please.
A couple minutes,
And
you kick that off.
that's yes. So as the UK is first, I can sort of run through the UK consideration, but we can take them in turn. So earnouts, it sounds like, and you and I discussed this the other day, how first of all, I think I have seen an earnout in pretty much every single SaaS deal I have done in the last 24 months at least. So it's definitely something to consider and get your heads around. What does it mean to be part of an earnout? Ultimately, the buyer is saying, you've built a cool business. I think that's great. I'd like you to stick around and to keep growing it. And so we're going to pay you some consideration now, but you're going to be paid more if you stay in the business and continue to let it grow.
Yeah, I would agree. My greatest recommendation when it comes to earnouts is know that it's coming. Work with your advisors, but really think about what is the post-closing control that you need to increase the likelihood that you'll hit your earnout. Most buyers will say that they don't want to contractually agree to any post-closing control. They're taking the business. Everybody's incentives are aligned. We make money, you make money. We have too many stories about that changing after closing. But if you come to the table and say, I want total control after closing, that's a non-starter. So really think about, what are objective measures? Are there key people? Is it your pricing strategy? Is it your account management? that you want to make sure stays in place after closing to increase the likelihood that you hit that earnout when you could hit it.
Agreed with that. And I've just seen that Robin, we've got a minute left, so let's rattle through these.
Let's wrap it up.
But very much worth considering earnouts, and that's probably of the many things that get negotiated in deals, earnouts are often heavily negotiated, so worth understanding that. I'm just going to basically point to the screen. I hope that makes sense for most of you. I'd say the key ones to focus on in terms of big comparisons. Escrow, I know that escrows are way more typical in the US, so that's probably worth just having a quick chat about. And then disclosure and liability. So your purchase agreement, whether it's asset or shale, is going to have a set of warranties. They can be anywhere between 10 and 50 pages, depending on who your buyer is and the complexity of the deal. In the UK, a seller will disclose against those warranties. That is also done in the US. However, they are treated differently. In the UK, warranties are statements that are given as to the status of the company. And if any of those are incorrect, then the buyer can bring a warranty claim, which is a breach of contract claim. And that means they have to prove their loss and the remoteness from the loss in the courts, and ultimately their damages. And damages is all that they might be able to recover. This means that the liability cap is much, much higher in the UK, and it says 25 to 50% there. Often deals require a 100% purchase price cap on liability. So that, I think that's the key one that I would focus on. And Robin, you can tell us about the key difference of that in the US.
Yeah, no, I mean, I think you said it beautifully given the timing that we have. And I think that the key really comes down to recognizing that M&A actually does have customs depending upon where you're doing it, and thinking about, particularly in a cross-border, which customs do you actually want to rely on, and selecting that jurisdiction for where you do the deal.
Great. Thank you so much, Robin and Caroline. I'll ask you all for your key takeaways for the group in a moment. Just want to spend 2 or 3 minutes on valuation. So on the left, I want to talk about the drivers of valuation, which we've touched on throughout this webinar, and then show you the resulting valuation ranges for different categories of SaaS businesses. So let's go back to global M&A activity. We're scoring it a 5 out of 10. It's broadly flat year on year. Hopefully it'll improve marginally, but it's not rocking and rolling like it was in 2021. SaaS trends are tough. We've seen annual recurring revenue growth based on the OpEx engine data, declined quite significantly. So that, it's a tough context. So we're saying that scored a 5 out of 10. Public market comps are trading sideways over the last few years. About 6.2 is the median today. So we're scoring that 4 out of 10 just because of the historic context. The good news is that there is lots of SaaS M&A activity. There are lots of buyers. There's lots of deals getting done in this particular vertical. There are other sectors that are not seeing much deal flow, but there is plenty of SaaS M&A activity, which is good. Firm metrics. It depends on your business. This is where we go from the macro to the micro. So if you're outperforming the market, if you're beating some of those stats that Catherine showed, then you have and you're well prepared, then you have a great chance of getting a deal done. From a deal dynamics perspective, it sort of goes hand in hand with SaaS M&A activity. There is lots of money being put to work in SaaS. There are lots of SaaS roll-ups looking to do deals. There are lots of strategics looking at deals. And if you're well prepared and understand the process that Caroline and Robin laid out and have all your ducks in a row, then that can result in actually getting a deal done. Remember, 80% of deals don't get done. So your first job is to get in the 20% club, and then think about where you end up from a valuation perspective. So where do we see valuations? First of all, there's a huge range. We've got 3 categories. There are a lot of distressed businesses out there that are not growing and they're not dressing themselves up for market. They don't have positive EBITDA, etc., or break even EBITDA. We would say they're pricing anywhere up to 3 times revenue. Most businesses that come to market, we would put in sort of the growing and profitable bucket, and they're trading between 3 to 6 times revenue. Anything above that right now, we would call diamonds. And yes, there can always be exceptions. There might be some that can trade above 10x for whatever reason. But generally, I think this is a fair snapshot of the market based on all our conversations with acquirers, looking what other M&A firms are saying is based on deals they're doing. And then to peg it to the listed stat that we showed earlier, the index of 120 listed companies is trading at 6.2 times today. So typically you'd expect to see a discount to that for an unlisted company. So that's where things are broadly today. Of course, if you're planning to sell in 1, 2, 3 years' time, those numbers will be likely to be very different. And again, you've got to be thinking about, should you be focusing more on revenue versus net margin, depending on the market. So you got to try and skate to where the puck's going to be, which means you need to be constantly speaking to your advisors, legal, accounting, M&A, to sort of know how to optimize your business for the sale and be reflecting on the data that Catherine showed to sort of dress up your business in the right way to get the best terms. So to finish, I'm going to ask all of our speakers to just give their single takeaway to you all. Mine is fail to prepare, prepare to fail. I've said it a few times, but please think about the flirt, date, marry approach. If you want to ultimately yield a great marriage and give your baby into the right hands to let someone else take it forward to the next chapter, it takes time. So please give it due time and consideration. Catherine.
My takeaway is about, you really want this balanced performance between your growth and your margin, and you want to know where the bar is set, right? You want to be in line with the market on this slide. You want to be in line or better, of course, right? In line will get you in the 20%. Better of the market will get you a larger valuation. And one data point that I wanted to bring up is Bain obviously does a lot of support on PE deals. One of the things that they've seen in their data set is that in the past year or two, the valuations for companies that have a more balanced mix of this rule of 40, and especially where the profitability is better, those are the valuations that are spiking.
Very good. Thank you, Catherine. Caroline?
Thank you. I said engage in the process and balance risk and reward. Engage in the process means, and I often say this to entrepreneurs, that to Emmett's point right at the beginning, this process it becomes a full-time job, which means that you are taken away from your actual day job for quite a period of time. So engaging in the process and understanding where you are in the process and what it means is just a good thing to be wary of, so that you can balance the 2 full-time jobs at the same time. And balancing risk and reward is to some of the items that Robin and I picked up on. There will be terms attached to the purchase, and it's important to understand what that means in terms of the risk that means for you versus the reward, the cash that will end up in your pocket, and engage with your advisors. They will help you to work through that. Robin, over to you.
Thank you. I talked about a lot, right? That legal structure can actually put dollars in your pocket and take them out. I think the other thing that really puts you in the 20% is speed. So once you are actually in the process, you've got your LOI, time can kill deals or time can make deals happen. So make sure that on the sell side, you're pushing the timeline of the process as much as the buyer.
Thank you, Robin, Caroline, and Catherine, for all that great content and advice for the listeners. A reminder that we will follow up with a PDF and a recording of this webinar. And if you have any questions for any one of the speakers, the emails are here on the screen. Please don't hesitate to reach out. So thank you very much for your time, and I wish you all a great day. Bye-bye.